Nilesh Shah joins us. Let's take our conversation forward. Nilesh, fantastic to have you back on ET now. Before we start our conversation, let me extend season greetings and best wishes for 2021.
Nikunj bhai, all the very best in 2021 for the ET Now viewers and yourself.
So where are you joining us from? Goa, home, or some exotic destination?
Totally working from home.
Well, what a year it's been, Nilesh, for all of us. Working from home is the new normal, and I guess the world has adjusted very smartly to it. Nilesh, in 2021, we have seen all emotions I could possibly think of market behavior. Fear, crash, meltdown, financial Armageddon, followed by comeback, majestic rally, FOMO, and euphoria. For 2021, what will be the dominant market behavior?
Nikunj bhai, a lot will depend upon how vaccination solves this virus problem. If there is no further trouble on the mutation of virus, if people can resume their normal economic activity, then we will see bullishness continue in the market. It doesn't mean every month market will go up. There will be ups and downs. But by and large, this bullish trend will continue. However, in that unlikely scenario where mutation of virus forces us to take corrective action and normalcy of economic activity is disturbed, then certainly markets will again go through a swing of bearishness. So a lot will still depend upon how medical situation pans out.
Point. But let's assume that on the medical front, what experts are claiming that the vaccine will work on the virus mutation also. Let's work with an assumption that there is no emergency on the medical front. If that is the underlying assumption, then how do you see markets and economy moving, and how much of the good news in terms of an recovery or in terms of an economic activity is already baked in?
So economic activity is improving month on month. There are sectors like tourism, travel, hotel, retailing, which still require support. There are sectors like pharma, FMCG, which has really done well during the pandemic. And there are sectors like auto, power, which has recovered well. Incidentally, yesterday we witnessed highest ever power demand in India's history. It shows that economy is now returning normally. The data is still representing past. It will keep on improving month on month, and market is looking at the forward. Nikunj bhai, when we were kid, Amar Akbar Anthony was a very hit movie. There was a song in this movie which said, "होनी को अनहोनी कर दे, अनहोनी को होनी, एक जगह पे जमा हो तीनों, Amar Akbar Anthony." So this is a kind of unholy event where mother of bear market and mother of bull market happened in such a short period of time. And this has happened because of confluence of three things: flows, sentiments, and fundamentals coming together, which is why we saw this sharp uptick in market. And with flows, fundamentals, and sentiments coming together, I think markets can sustain their momentum.
I can see the Bollywood impact rubbing on off you. Is it what Mr. Kotak always refers to, that India is like a Bollywood movie and the ending is bad, or is it Lakshmi Iyer, because every time she refers to a lot of Bollywood movie names?
I think Bollywood and cricket connects with our audiences. They are able to understand a complex subjects like investments in a very simple way, where we can take examples of Bollywood or cricket. So our whole objective is to communicate in the language in which people can understand.
In a Bollywood movie, the ending is always good. So what is in store for investors now? For somebody who says, look, I missed the bus, I was on the sidelines, I have no other option but to come now. That's a compulsion. Are we in for market which has potential to give double-digit returns for next 3 years, or that's a far cry now?
I will put my money that yes, over next 3 years, lower double-digit return is possible in this market. And this is purely on the basis of fundamentals, because flows and sentiments can move the market in the short term, not in the long term. If we look at Nifty 50 companies' profitability for June quarter, it was roughly about 69,000 crore. It was way below expectations. In the September quarter, expectations were between 70 to 80,000 crore. The actual numbers came at 1,07,000 crore. This came on the back of drastic cost cutting, and despite 7% drop in sales, companies delivered 17% year-on-year growth. Now, if we are going to sustain this momentum, this margin, then undoubtedly markets are fairly valued and not expensive. And if that is the case, then over next 3 years, a lower double-digit return in equity market is possible. So a lot will depend upon whether companies will be able to sustain September quarter margin or not.
Nilesh, so, Bollywood and cricket aside, let's talk about the digital ecosystem, because that seems to be where everyone's attention is drawn towards, especially with this huge shift and pivot that COVID has brought about. Within this space, what is it that you believe would merit a long-term story for the next few years that can play out well? What kind of companies?
So we are essentially looking at companies which are using digital ecosystem to either increase their penetration or improve their efficiency and reduce cost. Now today it is fashionable to say that we are all digital natives, we are all leveraging digital ecosystem. The point is not that whether you are leveraging digital ecosystem or not, but are you leveraging enough and more than your competitor or peer? So it is our job as fund manager to pick up those companies who are actually using digital ecosystem to increase their penetration, improve their services and product offerings, reduce cost, and they have to do better than peers. So across our portfolios, we are putting special attention on how companies are leveraging their digital footprint. Now, this is completely different from going and investing in companies which are into the digital ecosystem. Unfortunately, in listed market, there are very few digital ecosystem plays. Majority of the digital ecosystem companies are in unlisted space. So we are trying to invest via our existing portfolio companies to leverage digital footprints.
Nilesh, there have, after the month of March where we saw that record outflow, there has been a deluge of money into the Indian equity markets with that liquidity flow robust as ever. What's the sense that you're getting as we step into the new year in terms of what the foreign inflows could potentially be like for emerging markets like ours?
So as of today, it looks like foreigners are bullish emerging market. And within that, China, Russia, and India seems to be cornering bulk of the flows. This is first time in our history where on 2 consecutive months, more than 50,000 crore worth of FPI buying has happened. This has never happened in the past. In fact, this 2 months buying is almost equivalent to previous year's buying. Clearly, that kind of momentum is unlikely to be sustained. I don't think so. We can absorb 50,000 crore a month for next 12 months. So at some point of time, this record flow will moderate. But in calendar year 2021, will FPIs be a net buyer of Indian equity? It looks quite likely.
Nilesh, I'm wondering what movie are retail participants watching? Well, yes, you've got the whole Robin Hood traders and, active participants in the markets have increased. But that's not really the same when it comes to mutual fund inflows or SIPs.
So in mutual funds, if we saw month of Feb, March, April, May, there were record inflows. In fact, in the month of March, when FPI sold 60,000 crore, we were buyers on the other side. And that was all possible because of our investors It's not as if we were sitting on cash anticipating correction and then when correction came, we became buyer. Now, from September onwards, we have seen redemptions across mutual funds. And this redemptions is primarily driven by family offices, institutional investors, high net worth individuals. The retail SIP flows by and large have remained robust. They are down from about 8,500 crore to 7,800 crore a month. But by and large, retail SIPs have continued. The discontinuation of SIP is more related to financial troubles at the retail investor end. But undoubtedly, family offices, HNIs, institutional investors have booked profit in this rally, and that is reflected into our redemptions.
Sure. But Nilesh, for new investors who are watching this show and, follow you keenly, if they had to make fresh allocations, assuming that they are the millennial investors in their 20s, perhaps just begun earning, how would you asset allocate for them?
So for millennials who have higher risk appetite because they have a long-term career ahead, my recommendation will be to overweight risk assets, which will be equities, gold, real estate, and underweight fixed income because they have ability to take higher risk and hope to generate higher return. Second, my recommendation will be to follow this simple principle. Income minus expenses equal to savings should not be followed. Income minus savings equal to expenses should be their motto. So every year, every month, save something. No matter how small it is, every small drop of water will create an ocean eventually. And third, try to invest regularly. Open SIP in equity mutual funds. Create a diversified portfolio of 4 or 5 mutual funds across large cap, mid cap, small cap, and stay with it throughout the cycle.
You speak to your team, and when your team reaches out to some of the HNI investors and family offices, are they taking a slightly more constructive view of mutual funds and mutual fund investing? Because like you mentioned, India cannot digest or absorb 50,000 crores of flows on a monthly basis or on a quarterly basis. Similarly, this kind of selling from DIs has to stop one day.
Undoubtedly, today we believe HNIs, family office, institutional investors will be underweight equity, and they are probably hoping for a correction so that they can put their money into the market. If you look at overall savings pattern of India, equity remains an underinvested class for all except promoters. I do believe over a period of time, equity will become an important part of an individual's portfolio. And this aberration of DII selling of last 4 or 5 months slowly and steadily will disappear.
Okay, there are two classic signs which market veterans like yours, they have always called them as red flag. One is the IPO market activity, and second is activity from retail investors in below the ladder stocks. Both of them currently are at a peak. Looking at what is happening in the IPO market, 100 times subscription, 200 times subscription, and how the retail activity in some of the below the ladder stocks also is at a record high, not in terms of price but in terms of participation. Can we continue to ignore these basic red flags which time and again have proven that you need to be watchful when these things happen?
So, Nikunj bhai, in IPO market, when the quality of company comes down, then definitely it's a clear sign of a bubble. In 2008, we saw infrastructure companies raising capital without business plan. We saw real estate companies raising capital on the basis of just plot of land. We saw companies with no sound business fundamentals coming and raising capital. Fortunately, this time we are seeing companies with good businesses coming to raise capital. And because of limited floating stock, because of concentrated buying, it does happen that some of those stocks are trading at excessively high valuation. So I will definitely be cautious about those IPOs where, due to limited floating stock, due to concentrated buying, prices are rising and valuations are expensive. But overall IPO market still does not allow a kachra company to come and raise capital. When that happens, you need to be worried about market. Retail investors' participation, again, this time, if we see, it's far more in quality stocks. They have bought frontline stocks, they have bought quality mid caps. Yes, there is some amount of buying in small cap stocks also, but from a valuation point of view, things are not looking that expensive. So I will watch retail frenzy, I will watch IPO market activity. As you mentioned appropriately, both were red flags in the past, but as of today, these red flags are still amber, it's not red.
Okay, fair point. So let's close our today's interaction with one idea. For example, just for the benefit of our viewers, Kotak AMC and Nilesh Bhai, they've been talking about buying into cement. It's been a call which they took in 2019. It took them 2 years, but now cement stocks are all blooming and blossoming. So what is that idea where you are saying, look, I'm a buyer right now. I may have to go through volatility and time-wise and patience, but this could be a winner, or this could be a big theme in making in 2021 or even 2022.
So my feeling is that home improvement companies, they will be big outperformer in 2021. Nikunj bhai, many of us have worked from home, and our home needs improvements, whether it's tiles, paints, consumer durables, furniture, fixture, fittings. Globally, people do it themselves by buying material from the market. In India, we have the luxury of hiring a contractor and a laborer and get those things done. This whole of 2020, many people didn't open their house for outsiders, and hence home improvement probably suffered a little bit of setback. There is a pent-up demand which will come handy in 2021 as vaccination allows people to open their homes. Second thing is real estate. We have seen record buying in markets like Mumbai and other places. So real estate activity also will pick up. Every new house will require some sort of improvement. Put together primary and secondary demand for home improvement items, right from tiles, furniture fittings, consumer durables, wires, cables, paints, cement, everything will take off, and we will see that sector outperforming market over 2021 and maybe even 2022. I mean, as we speak, you can see Century Ply and Asian Paints both have delivered great return.
Okay, fair enough. Wanted to also understand if you're seeing opportunity in sectors, the likes of specialty chemicals, agri-linked sectors as well. Do you think that there is a merit for a long-term story here?
So, we were one of the early proponent of chemicals and specialty chemical sectors, and across our portfolios, we have remained overweight that sector for quite some time. This sector is like technology sector of 2000. Global buyers are moving out of China, and apart from other countries, they are looking at India. Our global market share in chemical has gone up, and by virtue of that, we have a great future in chemical business. Many of the large chemical companies are also investing for expansion of capacity. Now, from a market point of view, almost all chemical stocks have rallied significantly in last 1 year or last 3 years. Valuation-wise, they are priced for perfection. So at this point of time, there's no doubt on the growth side, but the valuations are priced for perfections in chemical sector.
But auto as well that has been in the limelight. And while there have been divided sound bites coming in with respect to the two-wheeler sector not seeing an encouraging growth, and then some alluding to the fact that there has been very strong growth within the auto sector with people going all out and purchasing cars, what's your stance when it comes to autos?
So within auto sector, we have been more bullish on four-wheeler sector and two-wheeler companies which are more focused in rural India. We believe rural India demand has revived for automobiles, and on passenger vehicles because of this lockdown, many people have probably pushed up or preponed their buying so that they can provide a safe transport mechanism to their family members. Put those two things together, we are bullish passenger car company, especially at the lower end of this segment, and two-wheeler company which is more focused on rural India.
Sure. Nilesh, great to have you on the show, and we'll see you again in 2021. Here's wishing you a very happy and healthy new year from all of us.
Thank you.